Hi, I'm Al Brooks. This is a bonus video to the Brooks. Hi, I'm Al Brooks. This is a bonus video to the Brooks Trading course. I want to talk today about 3 patterns that every trader and every investor should know. I want to begin by talking about my definition of price action. It's basically any movement that you see on a chart. And the 3 patterns are: first, a strong bull trend, a pullback in a bull trend, and then wedge reversals, either a wedge reversal bottom or a wedge reversal top. And then I have a little slide at the end about my 2 websites. First, I want to begin by talking about what I think price action is. This is a weekly chart of one of the biggest companies in the world. The blue line is the 20-bar exponential moving average. And as you see it, I removed the price axis and the time axis. Price action is simply market behavior. And the reason why traders look at price action is because they're hoping that it repeats. Every chart that you see is simply a record of transactions between buyers and sellers. And a price action trader is looking for patterns, hoping for clues as to what will happen next. Price action is just a map of rational human behavior. And there are many variations of it. And an experienced trader can see different variations of the same patterns repeat over and over. And this is true for every market and every time frame, and it always has been true. I've looked at charts back from over 100 years ago. And if I remove the time and the price, I cannot tell if the chart is today or 100 years ago, and I cannot tell if it's Apple or gold or crude oil. And I am a very experienced price action trader. The point is, I trade all markets and all time frames the same, as do all experienced traders. I remove the labels so that you don't get distracted and focus simply on the price action. If you watch any business TV show, you'll see charts of different time frames in different markets. It might be an hourly chart, it might be a monthly chart. You never hear anyone say that this is a weekly chart and therefore I'm going to trade it differently from an hourly chart. And you never hear them say this is Apple and therefore I have to trade it differently from how I trade gold or crude oil. And that's because traders correctly believe that price action is simply rational human behavior, and therefore it's going to be the same on all time frames and for all markets. And that has always been the case, and it always will be the case. Yes, computers alter the speed of things, but they do not change the fundamental principle that price action is a reflection of rational behavior, and the computers trade rationally. Although sometimes they appear irrational, everything they are doing is consistent with rational transactions. There are lots of patterns, and I want to talk today about 3 of the most common and therefore 3 of the most important. For example, here, obviously the market's starting in the lower left, going to the upper right. It's a bull trend. And when the bull trend is very strong, by strong I mean tight channel, pullbacks are small and brief, that is a very strong bull trend and traders should only look to buy. You can see there are several bars closing on their highs and closing above prior highs. So those are all breakout bars. And if you looked at a higher time frame chart, this would simply be a series of big bull trend bars with no bear bars and no pullbacks. And therefore, it's a breakout on a higher time frame chart. Therefore, even though you can see reversals in bear bars, you should only be looking to buy. Here, this bar went below the low of that bar, so we have a pullback in the trend. And I want to talk about buying pullbacks in bull trends. Again, you should only look to buy. We have 3 legs down, a reversal up. We have 3 legs up and a reversal down. This is a wedge bull flag, a wedge bottom in a bull trend, and this is a rally, it's forming a double top, but it's a wedge and it's a top. So traders will look to sell a reversal down. First, I want to begin by talking about a strong bull trend. Again, the blue line, a 20-bar exponential moving average. This is an extremely strong bull trend. We have a 1-bar pullback. We went sideways for a few bars, but the pullbacks are small. It's a small pullback bull trend, one of the strongest types of bull trends. Pullbacks are small and brief. Sometimes you go sideways for several bars, but the pullbacks are still small. You should only look to buy. It's unusual, and therefore it's unsustainable. It's a buy climax. However, buy climaxes can last a long time. And this one lasted a lot of bars. In fact, the entire day is basically a buy climax. Because they can last a long time, traders should only look to buy. And if you looked at a higher time frame chart, for example, let's say this is a 5-minute chart and you looked at a 15-minute chart, it would simply be a series of bull bars with no pullbacks. And that's true if you look at a 30-minute chart or an hourly chart. And therefore, if it's so strong that there are no pullbacks on the next higher time frame, on this time frame, you should only be looking to buy. Well, how do you buy? Well, the easiest thing is you look for a bull bar closing on or near its high, and you simply buy using a stop above the high of the bar. And where do you put your protective stop? Initially, at the bottom. A lot of traders look at it and say, oh my gosh, I did not buy. I should have bought here, I should have bought here, and now we're up here. What do I do? I don't want to miss the trend. Maybe I should wait for a pullback. But if you wait for a pullback, you're going to miss a lot of the trend, and you'll be buying up here or up here. The easiest thing to do is look at where the stop has to be, decide how much risk it is, and then trade a position that allows you to not risk any more on the trade than you would on any other trade, and simply buy using a stop above the high of the prior bar. Another way to do it is simply buy calls or call spreads. For example, if this is a daily chart or weekly chart, you might simply want to buy a call or buy call spreads. After every new strong leg up, you raise the stop to below the bottom of that most recent strong leg up. Here we have 2 or 3 bull bars. At this point, you'd raise the stop to that. Here we're starting to rally again. So somewhere in here, you would raise the stop here. And that's true no matter where you bought. If you bought here, if you bought here, if you bought here, and you're still long, at this point, your stop is here. So had you bought down here, and now it's up here, and you get stopped out, you're going to end up with a very big profit. But your stop has nothing to do with where you enter. Your stop has simply to do with what the market has been doing. And no matter where you buy, if the market is up in here, your stop is going to be here. And after every strong breakout, you raise your stop. Lots of bars with bare bodies, lots of bars with prominent tails. It never looks like it's going to last. It always looks like it's about to enter a trading range or reverse. But the pullbacks are small, 1 bar, 2 bars, 2 or 3 bars, 4 bars, sideways. They don't go down very deep. And you know that this is going to be a strong breakout on a higher time frame, and therefore on this time frame you should only look to buy. You have to be confident that the market's going to go higher. Also, look at this. We're pulling back and look to the left. It held above a breakout point. We have a breakout here, a bull bar closing on its high, closing above that high. So it's a breakout, and the pullback stayed above that high. Here we have a breakout, more breakout, and we tried to reverse down, but we could not get below the breakout point. So there were several gaps on the way up. Here we have a pullback below the breakout point, but the bodies do not overlap. The bodies of the pullback bars do not overlap the bodies here. So that means this is a gap, but it's a body gap, a gap between the bodies. And if this was a line chart, you'd see an actual gap because the line chart corresponds to the closes of the bars. It ignores the tails. and there still would be a gap here, and therefore it's still a sign of strength. Strong bull trend, and therefore you should only buy. The bulls are so eager to buy, they don't expect it to fall below the last breakout point, and therefore you should only be looking to buy. All bull trends, every strong bull trend, is constantly forming tops. And the most common one that you'll see will be wedge tops. And there are all kinds of ways to draw wedge tops. But if you look at the chart and you conclude it's a small pullback bull trend, you should ignore the wedge tops. You should assume that every one of them will fail, become a bull flag, and lead to a resumption of the bull trend. So do not worry about all the wedge tops, and do not look at the wedge tops, because you know the trend is strong. You should only be looking to buy. You should buy for any reason. I said the easiest way to do it is simply look for a bull bar closing near its high, buy above the high of the bar. Bull bar closing near its high, buy with a stop above the high of that bar. Same here, buy with a stop above the high of that bar. And you just do that all during that trend. You don't have to take every buy. A scalper will keep buying, taking profits, and repeatedly trade that way. But most traders will find themselves taking the first or second buy and then not taking any more, and they miss the whole trend. So once you think it might be a small pullback bull trend, look to buy and hold, rely on your stop and hold. If you're a day trader, one of the things I tell people to do if they find themselves scalping out is to go to Walmart. Go away for a couple hours so you know where your stop has to be. So if you buy above this bar, your stop is here. Just put your stop down there and go to Walmart and come back in an hour or two, and you'll find that you've made a lot of money. In addition to buying above the high of the prior bar, you could also simply buy at the close of any big bull bar closing near its high. And how do you do that? As soon as the bar closes, you can just hit buy the market. Or what you could do is as soon as the bar closes, place a limit order to buy the close of the bar, and you get filled on the next bar. In general, it's better to buy at the market because sometimes it will not come back to your limit order and you will not get filled. Remember, the market's in a bull trend and every reversal attempt will fail. So another thing you can do is just look for a bear bar closing near its low, and as soon as you see it, you buy the close. You buy the close of the bear bar. So right as soon as that bear bar closes, you buy the market. You just buy at the market. The market has been above the average price for 30, 40, 50 bars. Well, that means bulls have been very eager to buy. They have been willing to pay an above average price for all of those bars. When they finally get a chance to buy at the average price, they'll take it. So you can place a limit order to buy at the moving average, or as soon as it hits the average, you buy at the market. Another thing to do is every time you see a bar, you place a limit order to buy at its low, thinking that the reversal will be small. It'll be a small pullback. This is especially good if you have a bull bar. So anytime you see a bull bar, you place a limit order to buy at its low. And in bear bars, you can do that as well, especially bad sell signal bars like a doji like that. Here's another bull bar, so you could place a limit order to buy at its low. And as I said, every time you see a bull bar closing near its high, you simply place a stop order to buy just above the high of the bar. The idea is to get long and stay long. You buy for any reason in here, put a stop down here, and you don't get out until there's a logical reason to get out, because these small pullback bull trends can last a long time. Every new breakout, you raise the stop. No matter where you bought, you raise the stop. So anytime in here, the stop is now here. Anytime in here, no matter where you bought, the stop is here, below the bottom of the most recent breakout. There's often profit taking late in the trend. Therefore, it's reasonable to get out if you want, but the odds are it's still a small pullback bull trend. The odds are it's not going to go down very far, and bulls will buy that low and buy more lower. But it's okay to take profits. You can always buy again above a bull bar, above that bar, or above this bar, or above any of these bull bars. You can always buy again above the high of a bull bar. A pullback in a bull trend. This is the second pattern. We were drifting sideways, and then we had a huge major surprise bar, bull major surprise, and follow through. So clearly a strong bull trend. And the first time the low of a bar is below the low of the prior bar, you have a pullback. And traders will bet the bull trend will resume. One way to enter is you place a buy stop one tick above the high of that pullback bar. I call that a high one. So it's the first attempt to resume up. Sometimes you get a lower high in a second attempt, and that would be a high two. Sometimes you get 3 legs down and a resumption up. That could be a high 3 or a wedge bull flag. Sometimes it's sideways, and it could be a triangle. But the first pullback that resumes up is a high 1 buy signal. Stop very far away, so you have to put your stop down here. If your account is too small to risk that much, you do not take the trade. Or if you're trading, for example, E-minis, you could always trade a micro E-mini. If you're trading a stock, instead of buying 1,000 shares, you buy 100 shares. Or you can even buy 10 shares. Forex market, you obviously can take any size position. After every breakout to a new high, you raise the stop to below the bottom of the most recent leg up. If you have 3 or more consecutive high ones, this is an exceptionally strong bull trend. This is very unusual to have a series of high 1 bull flags like that. This is a very strong bull trend. Here we have a bull trend. It's a bull leg in a trading range, but it's also a small pullback bull trend. We're getting a reversal up, so that is a high 1 buy signal bar, and it triggered when we went above the high of the bar. For me, I would not take that buy. We have 3 bear bars and a doji bar. This is a low probability buy. The bear trend continued down, and now we have a second reversal up. This would be a high 2. This would have a higher probability of profit. Before making a new high, we reversed down a third time, so you could call this a high 3. I would not. I would call this a big complex pullback. So this would be a larger high 1 subdividing into 2 pieces. The bull trend tried to resume, and then we had another small couple legs down. So for me, I would look at this as a complex high 1 with 2 parts to it, and then a high 2 over here. It doesn't matter how you label it. What matters is it's still a bull trend, and it should be resuming. You got to be looking to buy above a bull bar closing near its high. Five bars without a bull body, so this is not a very strong buy signal despite the bull body. So it's a weak high 2, so that means maybe we'll get a high 3, or the first reversal up will fail, be a bull trap, you'll get a lower high, and then a second leg down. This is what I was talking about. You can view this as a complex high 2. We subdivided into high 1, high 2, and it became a larger high 1, and then we got a second leg down to a larger high 2. It's still a higher low in a bull trend. It's still trying to hold above the moving average. I would not take that high 1 buy. Personally, I would not take this high 2 buy, but this is a larger complex high 2. I would take that or buy above these other bull bars closing near their highs. A rally and a pullback. This is a high 1 buy signal. A new high in the rally, another pullback, another high 1, another new high, a pullback, another high 1 above that bar. It filled, and we got another leg down, but your stop is still probably down here, the bottom of the most recent breakout. So theoretically, if you took that buy, you have to allow for the possibility of 1 or 2 more legs down, stop below here or below here, and then we resumed up here. You could either buy above that or wait to buy above that. Here's a high 1, but only a small bull doji. We have a bear bar here, another bear bar here, not all that good. This is higher probability, but it's a pretty tight bear channel. So I would wait for a better buy setup or wait for a breakout and then buy after the breakout. Here we tried to get a high 3, but did not trigger. This did not go above that. And now we have a high 3. So you can draw a line along the bottom, 1, 2, 3. And this sell-off is a higher low. I would call it a wedge bull flag. I would not buy above the doji, but I think buying above that or above that is pretty good. We have a high 2 bull flag, but it continued down. Therefore, I would call it a wedge bull flag and a high 3. I would rather buy above a bull bar closing near its high. That is a higher probability buy. And your initial stop is here. But once you start breaking out, either once you're here or here, you move your stop to below this bar. I talk about high 1, high 2, and high 3 patterns as pullbacks, either in a bull trend or in a trading range. If the market's in a trading range and you have a swing down that has 2 legs in it, it would be a high 2 buy signal bar. Today, when I'm talking about pullbacks, I'm talking about strong bull trends. I'm not talking about buying pullbacks in trading ranges or in weak bull trends. As far as a high probability setup for traders, it's better to look for a strong bull trend and then look to buy a high 1 or high 2 bull flag. Pretty strong bull trend, high 1 here, high 2 here. Pretty strong bull trend. We tried to trigger a high 1 here, did not trigger, so you could call this a high 1. On a smaller time frame, it probably did trigger, and it's a high 2. But in this time frame, this is a high 1. We have a big gap up, 2 pushes down, 1 pullback, 2. You could call this a high 1. On a smaller time frame chart, it's 2 legs down. It could be a high 2. But in this chart, it's a high 1. Not great buying above a bear bar and a doji bar, but that is a high 1 pullback after a big gap up. This bar, it's a pullback. It did not go below the low of the prior bar, but it's a pause. It's an inside bar. Its high did not go above that bar's high. So I would also call that a high 1. This high is below that high. That's a high 1. And this is a second reversal up. If you want, you can call that a high 2. Here we have pretty strong rally, and this high is below the high of that bar. So that's a high 1 buy. It triggered, but it immediately reversed down. I think if you take that buy, your stop is down here, the bottom of the most recent leg up, and you hold, because we could get more of a pullback, yet the trade still could be profitable. Here, we have another pullback from a new high. 6 bars in a bear microchannel, so not all that high probability. Higher probability is wait for a second buy above that. You could call this a high 2, a sideways high 2, or you could wait for 2 or 3 bull bars closing near their highs and start to buy above those bars. The risk is greater. However, the probability is higher. Again, I said this is a high 1. We did not make a new high. We're trying to reverse up a second time. You can call that a high 2. I want to make an important point about high 2s. A high 2 means the bears twice tried to reverse the market down. And if they fail twice, most bears will exit if the bull trend resumes up. And that's why high 2 bull flags are especially good, especially if they're at the moving average. The bears tried to get a reversal down. They failed, but a lot of bears might hold short if they sold below that or that. However, if it reverses up a second time, most bears would give up. Therefore, a high 2 is a higher probability buy than a high 1. Another example of a high 2. The bears tried to get a reversal down. They tried to reverse down a second time. It's failing a second time. Higher probability that will go up. If you take that buy, could you put your stop here? Well, you might put your stop here initially, but maybe by the close of this bar, you'd put your stop here. Every double bottom, here we have a small double bottom, this low and these lows. Every double bottom is a high 2. Here you can also call it a triangle. You have three bottoms, and we have a lower high, and we have a higher low here. I know it's not a perfect triangle, but it's sideways and it's getting tighter, so I would call that a triangle. So you can either call this a high 1 and a high 2, or you could say, well, it's a triangle, so maybe it's a high 3, high 1, high 2, high 3. Sometimes you'll get one more new high, but it's still part of a correction. If you're taking a triangle buy, I'd put the stop below the bottom of the triangle. We have a gap up and a strong rally. We sold off. This is a high 1, but 4 bear bars, not a good buy. We have a second leg down to a new low. It's a higher low, and it's a double bottom with the low of the day. It's a high 2. I don't want to be buying above the bear bar, but this is a reasonable buy. 2 legs down, testing the moving average, testing the low of the day, forming a double bottom. Here, a higher low double bottom. So for me, this would be a high 2 bull flag. We have 1 leg down, and then a trading range, and then a second leg down. So this would be a large high 2 bull flag. I mentioned that I also want to talk about wedge tops and wedge bottoms. Let me talk about wedge bottoms first. I have a very loose definition of a wedge. For me, it's 3 bottoms in a bear channel, so a channel that's sloped down and it has at least 3 reversals. Sometimes it has 4 or 5. We're in a bear channel. This high is above that high, but it's still basically a bear channel, and I have 3 reversals up. Therefore, it's a wedge. You can see how I drew it using 0.1 and 0.3, and 0.2 is below. I'm always drawing channels so that there's an overshoot. Sometimes I'll use points 1 and 0.2 for the line, but I'll only do that if 0.3 would then be below the line. It doesn't matter how you draw it, but I personally like my lines to have at least one overshoot. So in this case, to get the overshoot, I'd have to connect 0.1 and 3. Sometimes if you connect 0.1 and 0.2, the third leg goes below. I'll pick the point for the line in a way so that there'll be an overshoot. Either the second point overshoots or the third point overshoots. But bear channel, 3 legs, usually some kind of convergence of the lines. And if you have a decent bull signal bar, especially if there's a micro double bottom or a second reversal up, that is a reasonable buy. You're expecting at least 2 legs sideways, 2 up. So 1, pull back 2. Therefore, I would not get out of longs below these bars because I'm expecting a higher low and a second leg up. Here, we have an extremely strong rally, but look to the left. We're at the top of a trading range. We're a little above the top, but this still could be a bull leg in a trading range, and it could be a buy climax. When you get the biggest bull bars late in a bull trend, especially if you're still possibly in a trading range, it will attract profit taking. Now, if you're a bear and you bought back your shorts here, you're expecting at least a couple legs up, and you'll look to sell probably near the top of the wedge. Now, why would bears not sell right away? If a bear got out after a 30-bar trend, he's not looking to buy back on the very next bar. He'll want to wait for a couple legs sideways to up. He wants to know if the bulls are strong enough to reverse the trend from a bear trend into a bull trend. He usually wants to give the bulls at least a couple chances to try. And that means the bears, before they sell again, will want to see at least a couple legs sideways to up. So 1, pull back 2. While this could be the end of the correction, as a general rule, I'm looking for 2 legs, 1, pull back 2. And I'm looking for the rally to have about half as many bars as the wedge. This does not have half as many bars as this. So I would expect at least more sideways to up bars. Once the bears decide that it looks like the bulls might be failing, they'll sell again. We broke out above the top of the wedge. First reversal down. Some bears will sell. But once you get a second reversal down, you'll start getting more bears selling and more bulls selling out of their longs. A wedge bottom, 2 legs up, 1 pullback 2, and very often after a wedge bottom, the pullback will also form the right shoulder of a head and shoulders bottom. So left shoulder, head, right shoulder. And the left shoulder is the second leg down in the wedge. So 1, 2, 3. This is also often a high or low major trend reversal. Big bear bar closing on or near its low, a failed breakout above the top of what could be a trading range, it's reasonable to exit longs below that bear bar, and bears will start to sell. Well, you look at a chart like this and you say, well, where do I draw the lines? I got 3 pushes down. Al says that's a wedge. Well, maybe it's 3 pushes down using that low, or this low, or that low, or this low. It's confusing. There are all kinds of ways to do it. Some computers will use these lows, other computers will use these lows for the first point. The more ways there are to draw the wedge, the more likely you're going to get a reversal, because you'll have more and more computers spotting the wedge. Some might not call this a wedge, but they might call that a wedge channel, or this, or this. And the more ways to draw a wedge, the more likely you'll get 2 legs sideways, 2 up. One way is point 1, point 2, point 3. Remember I said earlier that I choose the lines to draw the wedge in a way so that either point 2 or point 3 will overshoot. The example I gave earlier, point 2 is the overshoot. Here, I only get an overshoot if I use point 1 and point 2 to draw the line, and then point 3 is the overshoot. But there are lots of ways to draw this wedge. 1, 2, 3, 1, 2, 3, 1, 2, 3. Any of these for point 1. When there are a lot of ways to draw a wedge, a lot of the computers will be thinking reversal. It increases the chances that we will get a reversal. Not so good to buy above a bear bar. Maybe you buy above a bull bar here. But after that bear bar and a pretty tight bear channel with 4 bear bars, it's probably better to wait for a second buy, which would be above that or above that, looking for at least a couple legs up, maybe 1 pullback 2. Well, it's not enough bars. Remember, I want to see about half as many bars as there are in the wedge. So what about 1 pullback 2 or 1 pullback 2? Well, maybe, but even this is not half as many bars as there are in the bigger wedge. So this might be a complex 1 pullback 2. Different ways to draw the wedge, but the bottom is the same for all of them. That increases the chances that we'll get a reversal. Again, whenever you have a wedge, very often the higher low forms the right shoulder of a head and shoulders bottom, and point 2 is the left shoulder. So it's also a higher low major trend reversal. I want to make a point about this channel here. We're channeling up. I'm going to start looking for a wedge rally. Very often, the first leg up in the bull channel begins before the bear trend ends. That's because markets often go through a transition phase where the bull trend begins before the bear trend ends. And if you're in a bull trend converting into a bear trend, very often you start to get some evidence that the bear trend is beginning before the bull trend ends. Now, again, where's the wedge? Well, we had an attempt at a wedge here, different ways to draw it, 1, 2, and 3. And it's also something of a little double bottom. And you have a bull bar, and it's a second buy signal with the bull bar. So it's credible to buy there. Not great because of that tail, and the bars are not very big compared to the bear bars, but it's a reasonable buy. If you have a wedge bottom and you get stopped out, in general, you should assume 50% chance the breakout below the wedge will fail and we'll get a reversal up, and 50% chance the breakout below the wedge will be successful and we'll get a swing down. So some bulls who take that buy instead of putting a stop here, we'll use a very wide stop, taking the chance, the 50% chance that the breakout below the wedge will fail, and then they'll buy more above this or that. Other bulls will get stopped out below the bottom of the wedge, one tick below that, and take the second attempt to reverse up, either above that or above that. Sometimes a wedge can grow into a bigger wedge. Then this becomes a wedge buy signal as well. It also is a buy signal for a failed breakout below that wedge. Now we're starting to get very strong bull bars, big bull bars closing in their highs. And these bars are starting to become comparable in strength to the bear bars. Big bear bar, but tail below, tail above. Big bear bar, tail below, and we're getting stronger looking bull bars. This has a higher probability of a swing up. We have a second buy above that bar. Increased probability of a swing up, a second good buy setup. Now, here's the low, the start of the bull trend, but as it's going up, I'm looking for a bull channel. I look to the left, and maybe the bull channel began here before the bear trend ended. That's very common. You can see if I just use these lines and I extend them to the left, they connect to this high, and that tells you that this may have been the start of the bull channel. Markets transition from bear trend to bull trend, and there's often a period of time when both the bull forces and the bear forces are operating. So the bull channel sometimes begins before the bear trend ends. All right, do you see any wedges here? Well, what do you notice about this bar? It's big, it has a big body. In fact, look to the left. We have a bear trend, and this is the biggest bear bar coming late in the bear trend, 20 or more bars into the bear trend. When that's the case, 60% chance either we're at the end of the bear trend, which means we go sideways or we go up, or we get one more brief leg down, a pullback and one more brief leg down, and that will be the end of the bear trend. So if you see a big bear breakout late in a bear trend, 60% chance the bear trend is ending or ending soon. We have a tight bear channel with 3 legs down, 1 and then 2 and 3. So I would call that a parabolic wedge bottom, and it's within a bigger wedge bottom. So the third leg down in the wedge is a parabolic wedge. So you have a smaller wedge inside of a bigger wedge. That is a nested wedge. That is a higher probability for a reversal up. A reversal bar closes above the midpoint, closing near the high, but it has a bear body. Some traders prefer to buy above bull bars closing on or near their highs. So some traders will take the buy above that. Others will wait for bull bars closing on or near their highs, higher probability. Again, possible wedge bottom. Can you see? 1, 2, 3. A wedge bottom, but a bad buy signal bar, a bear doji, plus it's following a big bear bar. So not a great buy. You can buy above a bull bar, but both of these bull bars have tails on top and the bodies are not very big. So a lot of traders will wait for a second buy signal like that, or above this, or now we're getting a bull bar closing near its high, so that or above that. Higher probability that we're going up. If you start to get bull bars closing near their highs, traders will start to buy above those bull bars. If you took these buys, you could put your stop below here or below there, but at this point, I would have my stop either below that or below this, the bottom of what appears to be a reversal up. A lot of bull bars here. We're starting to get a lot of bull bars. Here we have a lot of bear bars, but now we're starting to get more bull bars, and a lot of bull bars closing on or near their highs. That's a sign of aggressive buying pressure, and it increases the chances that we're going higher. Again, different ways to draw a wedge bottom. 1, 2, 3. Here, a tight bull channel with 3 legs up. One pullback, and then a second breakout, pullback, and a third. So when you have a very tight bull channel with 3 tops in it, it's a parabolic wedge, and you often get some kind of a pullback. Sometimes you get a reversal into a bear trend. Now, as big as the sell-off was, look at the low. It held above this. So this is a pullback from this. Even though it has more bars going down than we had going up, it's a higher low. If you want, you can call it a wedge bottom, or you could simply call it a wedge bull flag. I want to buy above a bull bar closing on or near its high. This low broke below that, so it's a failed breakout below a wedge. You can also call it a wedge with a lower low double bottom. The buy did not trigger. We did not go above these bull bars, but we did go above that. And now we have a second bull bar. That's higher probability. And now we're not getting bear bars, so traders will start buying above the highs of bars, especially bull bars, for a swing up. Wedge, 1, 2, 3, but you see a button in there? So we got 3 legs down, but it's a pretty strong bear channel. Look how strong this sell-off is, a series of bear bars. Remember, if the market's in a strong bear trend, it's always going to be forming wedge bottoms, and you should not be looking for reversals up. If you're looking for a wedge, I would start the count over again once you have a strong leg like this. So I would not call this 1, 2. I would say, okay, I'm going to start it over again. This becomes a 1. Oh, we got another strong sell-off. Then this becomes a new first leg down, and maybe second and third. Or maybe 1, 2, 3. Different ways to draw it. Here we got a second reversal up. This is higher probability. Weak buy signal bar, tail, small body, after 3 bear bars, a tight bear channel. Better to wait for a second buy above that or above that. And if you take the buy, your stop is down here, and therefore you would not get stopped out. This is a higher low as well, so still okay to be long. Here, this is the start of a day on a 5-minute chart, and we have that low, 2 and 3, and then from yesterday we had this low, 2 and 3. Couple ways to draw a wedge. Different computers see it differently. Pretty good bull bar here, but 3 bear bars in a tight bear channel, not a very good buy. Here, it's a second buy, but a bear bar, not that good. Here, you get a pullback from this rally, but a very big bear bar, not all that good. And here, now we have 2 different ways to draw a wedge. It's a third or fourth bull bar, 1, 2, 3, 4, closing on or near its high. We're starting to get buying pressure. This would be a higher probability buy, wedge bottom. Where's the wedge here? Different ways to draw it. At this point, we're in a trading range. Yes, we have a lower low, but we have a higher high as well. It's a trading range. It's not clear. And in trading ranges, patterns often look bad. And that's just the nature of trading ranges. You have to assume things don't look like they should look or the way you want them to look. But they can still be tradable. We're in a trading range here, and then look at this. A small brief pullback, and then pause, pause. This is a small pullback bull trend. So it was a trading range day for the first half, and then a small pullback bull trend, a strong trend for the second half. We have a low, a pullback, a sell climax, a pullback, and a third leg down. So that's one way to draw the wedge. And then we have a strong reversal up, another strong reversal up. We're breaking below it, and this is a third way to draw it. Now, look at this, 0.1, 0.2, 0.3. I'm looking for overshoots. So To draw that line, I would use 0.1 and 0.3, and 0.2 is an overshoot. If I'm looking at this as a possible wedge, I want an overshoot, so I would use 0.1 and 0.2, and 0.3 is the overshoot. It doesn't matter how you do it, but when I draw my lines, I always prefer to draw them in a way so that there will be an overshoot. A triangle, fairly late in a bear trend, often a final bear flag. And then look at this, the two biggest bear bars of the entire 30-bar trend. As I said earlier, 60% chance it's either going to be the end of the selling or we'll get a brief leg down and that will be the end. And then finally, if you have a sell climax like that and you have a pair of inside bars, this bar is inside that, this is inside that, this is an II buy signal, that is a pretty reliable buy setup. It could be a bear flag. If it is a bear flag, it's often a final bear flag, but it's also a buy signal. You can buy above the bear bar, above that bull bar, or above this bull bar, or wait for the small pullback bull trend to begin. But you have a sell climax, two ways to draw a wedge, a possible final flag, and you have an II. This is a reasonable place to look to buy. All right, so where's the wedge here? Well, you got one here, you got one here. But remember what I said earlier. If the market is in a strong bear trend, it's always going to be forming wedge bottoms. When it's in a strong bear trend, you should not be looking to buy. You should only be looking to sell. Lots of bull bars, so lots of potential ways to draw a wedge. 1, 2, and then 3, or 1, 2, and 3. Lots of ways to draw them. But brief pullback, small pullback, lots of bear bars staying below the moving average. You only want to be selling. Another way to draw a wedge, possible low of the day, but a tight bear channel, probably a minor reversal. 2 legs up, 1 pullback, 2 to the moving average. I would rather look to sell on a reversal down from the moving average. Also a double top bear flag, a pretty common pattern. The market's trying to reverse up twice and it fails. Look to sell below a bear bar, especially if it's at the moving average. Here we have a bear breakout below a wedge bottom and follow through. You prefer a bear bar, but one thing you do not want is a good bull bar. So we have a bear breakout and okay follow through. So traders will sell below bars, below a bear bar here or below a bear bar here, taking a chance that instead of an exhaustion bar, we're getting a measured move down. Remember I said that if you break below a wedge, 50-50 chance the breakout will fail, 50-50 chance it'll reverse, except if it's a small pullback bear trend and you get a breakout, then it's more like 60 or 70% that you're going lower. A wedge reversal. So I want to talk about wedge tops. I talked about wedge bottoms, wedge tops now. Different ways to draw it. I got 3 points. I could use 1, 2, and draw the line up here, but it makes it hard to see the wedge. So I choose to use 0.3 so that we have an overshoot here. Remember, I picked the 0.2 or 0.3 for the line in a way that we'll get an overshoot. I'm always looking for an overshoot. So for me, this would be 1, 2, 3 legs in a rally. And to draw the line, I'll pick 1 and 3, and then 2 is an overshoot. Very strong rally, so it could start the count over again. So it could be 1 pullback, 2 pullback, 3, or 1, 2, 3, or you can call it a nested wedge. If you're a bull and you exit either below that bear bar or this bear bar, you're expecting at least a couple legs down. 1 pullback, 2, here 3. And you're expecting the reversal down to have about half as many bars as the rallies. Sometimes it can have a lot more. The bulls, they exit, and the reason they wait for a couple legs is they want to give the bears a chance to create a reversal. If the bears try twice to get a reversal down and they cannot reverse the market down, then the bulls will start to look to buy again. That means they'll start to look for a high two-bull flag. Here, the bears have 5 bear bars in a tight channel. We're probably going lower, so I would not be looking to buy. Stock traders prefer looking to buy, so they're not looking to short most. Some short, but most are looking to buy. However, wedges are still important if you're a stock trader, because if this is a weekly chart, for example, and you're long for any reason, it's a good opportunity to exit because we may get a deep pullback or a reversal. We have a very tight bull channel, so reasonable to stay long. But if we get a second reversal down, with bear bars closing on their lows like this, it's reasonable to get out. Bears will short, and some traders will short by buying puts or put spreads. Second sell signal, so here's the first. This went below these bars, and this is the second, when this went below these bars. We have a lower high, a double top lower high. Whenever you have a wedge and then a lower high, it's also a head and shoulders top, where the left shoulder is the second leg up in the wedge. And it's also usually a lower high major trend reversal. And you're expecting a second leg down, either here or here. Wedge, we have 3 legs up, 1 pullback 2, pullback 3. We have a first reversal down here. I could have drawn the wedge 1, 2, and 3. This is not a higher high, so it's not really a wedge. You can call it a truncated wedge, where the third high did not go above the second. But with these 2 bull bars, I'd wait for a second sell, and we have it here. Traders will start to sell below bear bars closing on or near their lows, looking for at least a couple legs down. Very strong leg down, very strong leg down here. So these 2 legs represent very strong selling pressure. It increases the chances that we'll eventually get a reversal down. The first pullback is often the right shoulder of a head and shoulders top. At the bottom, different ways to look at this. One is 1, 2, 3, possible wedge, or 1, 2, and 3. If this is a 5-minute chart and we're late in the day, it's certainly reasonable to get out of shorts on this reversal up. Even if it's a daily chart, we're down near a prior low, so you'd expect some buyers here. They bought at this price earlier. We're at that price now. So reasonable to get out of shorts down here. Here, I'm looking for a channel. I'm always looking for channels. This is a pretty strong leg down. Even though it's not the end of the bull trend, I'm still going to pay attention to it, because very often the beginning of the bear channel starts before the bull trend ends. I said a wedge has 3 or 4 or 5 legs up. Sometimes it has several legs up. Here we got a strong rally, a second leg and a third leg. It's a credible short, except this is only a small bear doji, and we have 2 big bull bars here. This is pretty strong, so this may have started the count over again. When I see that, a lot of times I will not take that short. I'll wait to see if we go sideways and get a second sell, or wait to see if we go higher and get another reversal down. You can call this a consecutive attempt at a wedge top. This would be a higher probability sell. Different ways to look at it. Strong rally here. The count may have started over on some computers, so it could be 1, 2, and 3. Some traders in a situation like this will take this sell, use a wide stop, just in case this is a new 1, 2, and 3. So they'll sell here, use a wide stop. Some will sell more here. Others will sell, get out above this bear bar, and then sell again there. In general, If you think there's too much buying pressure and the trend is too strong, it's better not to take the short and wait for a higher probability short. When in doubt, stay out. All right, so we're in a channel. Maybe we have a wedge. We do have a wedge, and it's a credible sell. We've got two small legs down, but we're starting to reverse up. So a lot of the bears who took this short after two legs down might get out above a second bull bar here, but most would get out after a third or fourth bar up, betting that the wedge top is not a top. We're breaking above the top of a wedge. Remember what I said earlier, 50% chance you'll get a swing up, 50% chance the breakout above the top will fail. And therefore, if we get a reversal after breaking above the top of the wedge, traders will sell, looking for the swing down. Very often you'll end up with a second way to draw the wedge, and you're looking for at least a couple legs down. Tight bull channel, a wedge, 1, 2, 3, or 1, 2, 3, or 1, 2, 3, different ways to draw it. But remember what I said earlier, if a bull trend is extremely strong, you should not be looking for wedge tops. You'll find them, there are plenty of them, but instead it's a small pullback bull trend. You should only be looking to buy. Look for bull bars closing on or near their highs. Here we have a breakout. Is this going to be an exhaustive buy climax? Are we going to reverse? No, because when you're in a small pullback bull trend, you often get breakouts. Here's another one, and the market can go up a long way. Wedge, 1, 2, and then a third new high. A decent bear bar, reasonable to sell or wait for a second sell below that bar. Very often, you'll get a test of the top of the wedge. Remember I said sometimes you'll break above the wedge and reverse down. Sometimes you'll get near the top of the wedge and reverse down. Sometimes you'll get a perfect double top like that. If you get out above this, a parabolic wedge, 1, 2, 3. If you get out of the short here we got two reversals down and a double top. It's a credible sell below these bear bars. So very often you get a wedge and then a perfect double top. Now we have a very strong bull trend and different ways to draw wedges. But when a trend looks like that, it's usually not worth shorting. However, a lot of times you'll get 3 pushes up, 1, 2, pause, 3, late in a bull trend. Then you get a reasonable sell signal bar. I think you should get out of longs in that case because you can get a deep pullback. You can always buy again later. And some traders will take the short. The risk is not big, and they're hoping for at least a couple legs down, maybe to the moving average. But at a minimum, bulls who are long, I think, should get out. Parabolic wedge with a bear bar, 20, 30 bars into the trend. A tight bull channel, so the reversal is probably going to be minor. Only maybe a 30% chance of a major reversal. Well, this is an example of that 30%. We have a pullback. The bulls look for a bull flag, but now we're starting to get gaps close below the prior bar, another gap, and it's starting to look like a small pullback bear trend. And we have a breakout and a bear follow-through bar. At this point, it's probably always in short. So instead of looking to buy, traders will look to sell. A breakout bar closed below the prior bar's low, and a follow-through bear bar, so lower price is likely. It could be a little bit lower or a lot lower. Today, it's a lot lower. A rally, a second reversal attempt, unable to get above the moving average, possible double top bear flag, and we never had a major trend reversal. A parabolic wedge is not a major reversal, it's a minor reversal. A traditional wedge can be major, but a parabolic wedge is usually minor. And so if you do not have a major reversal here, traders will think about the possibility that some lower high will be the start of a major reversal. And sometimes it's far below the original high. Double top, moving average, bear bar closing near its low. Traders will sell below bear bars closing near their lows. After this breakout, they'll be selling below bear bars as well. Sometimes you'll see a rally. Here we're far below the moving average. Traders are wondering if this rally will form a lower high and the bear trend will resume. Look at all the sideways bars, all the bear bars, all the tails. This does not look like a strong bull trend. So we have a first push up, a second push up, a third push up. Traders are starting to think this third leg up will be a wedge top and that we'll get a reversal down. And if everybody starts to think that there's going to be a wedge bear flag or a wedge top, traders will start to sell on the way up, just in case we do not get above the prior high, the second leg up. When that happens, you get a third leg up where the third does not go above the second, yet everybody was looking for a wedge. So we have a lower high, everybody's looking for a wedge, we have a reversal down after 3 pushes up. I call that a truncated wedge. If you want, you can simply call it a double top. But I think the forces are the same as in a wedge, and I would treat it like a wedge and sell looking for at least a couple legs sideways to down. And just a reminder, I have 2 websites, the Brooks Trading Course website, which also has my daily blog, and that's this website. And then I have the Brooks Trading Room at brookspriceaction.com. I began by talking about what I mean by price action, and price action is just movement on the chart. Traders look for patterns, and with experience, they can anticipate what will happen after a pattern forms. And I said I was going to be talking about 3 patterns. The first was a strong bull trend. When a trend is strong, I only want to look to buy. The second pattern that every trader should know is a pullback in a strong bull trend. And again, a trader should only look to buy. And then third, I talked about wedges. Wedges can be top, they can be a bottom, they can be a bull flag, they can be a bear flag. And finally, I talked about my 2 websites. I'm Al Brooks. I want to thank you for watching this video. I hope you found it helpful. 3 patterns every trader and every investor should know.